In Lesson 1.4, we're going to cover long-run returns and risks. In previous lessons, you've heard me state that common stocks have provided investment returns well above those of other investments. You also learned that stocks are riskier because they don't offer a fixed rate of return like bonds and savings accounts. Here we'll look at the historical long-run return of stocks and other investments to determine if they surpass inflation. We'll also examine if the rewards outweigh the higher risks of investing in these riskier assets. Most individuals know that stock prices are volatile. We hear on the hourly news reports about the activity of the stock market, and we know that stock prices can fluctuate widely. In fact, if you watch the market too closely, you'll get dizzy. The intraday fluctuations can even give the appearance that the market moves randomly. Academics who've studied the long-run returns and risks of investing in stocks and other assets have noticed these significant fluctuations. Looking at the yearly returns for the U.S. stock market since 1926, we've observed returns over a one-year period to be as high as 54% in 1933, and we've also seen negative returns of over 43% in 1931, and we also recently saw the stock market return a negative 37% in 2008. Now that's a lot of volatility. The table reveals that stocks have significantly outperformed inflation. And using the best measurement of return, which is the compound geometric mean, we can see that large stocks as a group have returned nearly 10% annually versus an average inflation rate in the range of 3%. That's a healthy real rate of return for stocks. The next table shows that stocks, on average, have significantly outperformed bonds and treasury bills, which shouldn't be a surprise to you by now, given that these are less risky. And we can also see in the table that the average annual returns of stocks are anywhere from 3% to 6% higher than most fixed income investments. The returns of the S&P 500 stock index produced an average risk premium of 4.4%, which is the return above the U.S. Treasury bond rate. You get this by taking the 9.6% return and subtracting 5.2. Got it? Good. This is referred to as the equity risk premium, a measurement that is used by stock analysts in identifying the additional return that's earned on stocks above the risk-free rate. The only investment in the table that we haven't discussed yet is small company stocks, which have been the strongest performing investment, generating a nearly 12% annual return. This higher return is often referred to as the small firm effect, and it's been the topic of much discussion by academics the past 30 years. The extra 2% annual return is quite significant when compounded over the long run. While it should be obvious to most investors that stocks are volatile, the results of this study show that risk is the highest for stocks. And we use the standard deviation, which is a statistical measure of volatility, to support this statement. And even though this measurement is a backwards look at investment risk, it does provide us with useful information. The next graph shows that a strong positive risk-return relationship exists over the long term. This empirical evidence has been used to support the all-important risk-return relationship, which serves as the basis for much of modern finance theory. These higher risks should result in higher returns in the long run. When stock and bond returns are examined on a monthly basis, the dramatic fluctuations of the former, which is the top segment, can be seen. The graph shows the significant monthly volatility of stocks in the late 1920s and 1930s. Other dramatic short-term declines in stocks can be seen occurring during the 1987, 2001, and 2008 bear markets. Bonds are clearly less volatile than stock, as shown on the graph. However, it's also apparent that bond returns have become more variable over the past 20 years. Despite greater volatility of common stocks, their cumulative returns are substantially superior to those of corporate bonds and treasury bills. The next graph, which is visually one of my most favorites, displays that a $1 investment in stocks in 1926 would have grown to over $3,500 by year-end 2012. Long-term corporate bonds would have grown to $175, and treasury bills would have grown to only $21. This chart really shows the power of high rates of return that stocks generate in the long run. Why have stocks been the best performing asset class during the past century? In short, equity investments allow ownership in firms that have the ability to create massive economic value. You're more than just a lender you actually own a part of a real company. So while riskier, stocks offer strong real rates of return on average in the long run. Stock investors have full exposure to the upside of owning a business as well as the downside risks of firm ownership. Because of this risk, stock investors require the higher returns compared with other types of investors before investing their money. This is why we focus most of our effort in finance on analyzing stocks rather than bonds. So in summary, investing in common stocks can provide returns that beat inflation and offset the additional risk. And they should definitely be a part of a long-term investment strategy. The next module will go into the workings of the financial markets, where you'll learn more about how these investments are bought and sold.